All right, today we're diving into a protocol that's trying to completely change how you earn rewards on your Cardano. So if you're an ADA holder, you're definitely going to want to stick around for this. So let me just start by asking you a really simple question. Is your ADA just sitting there? Or is it actually working for you, generating more ADA? For a lot of folks, the returns just aren't what they used to be. And this right here just lays it all out, doesn't it? Traditional ADA staking rewards have kind of dipped down to around 2% a year. But then, look over on the right. Supplying your ADA to the Surf protocol could get you closer to 6%. That is a threefold increase. And honestly, it's the main reason we're even talking about this today.
So what exactly is this protocol that's making these kinds of promises? Let's get into the nuts and bolts of the Surf protocol.
Okay, so this is Surf. At its very heart, it is a decentralized lending protocol built specifically from the ground up for the Cardano network. You can kind of think of it as a financial hub, but, without all the usual banks and middlemen getting in the way.
Now, for anyone who might need a quick little refresher, a DeFi lending protocol is basically a peer-to-peer system. It means you can be a lender earning interest on the assets you hold, or you can be a borrower using your crypto as collateral to get your hands on other assets. It's finance just decentralized. Pretty cool, right?
With Surf, there are really two main ways you can jump in, and they're built for completely different strategies and totally different appetites for risk. The real question is, are you a long-term saver or are you more of an active trader? Let's break that down.
So on one side, you have the savers. Their main goal is to supply their ADA to earn a nice, steady, passive yield. It's the lower risk strategy totally focused on income. Then on the other side, you've got the traders. They're the ones borrowing assets to make leveraged plays, all with the goal of amplifying their potential gains. It's definitely a higher risk, more hands-on approach. This quote just perfectly captures the spirit of the saver strategy. The whole idea is that it doesn't matter what the market is doing. If it's up, down, sideways, your supply data is just constantly chugging along, earning you a yield from the borrowers. It's a way to find some stability in all the chaos. And this is where the difference becomes, well, very real. Let's say you're an investor holding 1 million ADA. Standard staking might get you about 20,000 ADA a year, but by supplying that same amount to Surf, you could be looking at 60,000 ADA. That is an extra 40,000 ADA per year, a massive boost to your passive income.
Now, it is important to point out that this strategy really shines for those with larger portfolios. That 6% yield can take a substantial holding and turn it into meaningful monthly income, enough to help out with a mortgage, rent, or a car payment. For smaller bags, the impact just might not be as significant.
Okay, so now let's flip over to the other path. This quote just perfectly nails the trader mindset. If you're confident that you can predict which way a token is going to move, borrowing on Surfs lets you make a bet that could completely obliterate that 6% passive yield. So how does this actually work in the real world? Okay, imagine you think a certain Cardano token is way overvalued, and you're pretty sure it's going to drop by 20%. You could put up your ADA as collateral on Surf, borrow that token, and then sell it immediately. That's what we call a short. If you use 2x leverage and you're right, that 20% drop means your position actually gains 40%. And the result of a successful trade like that one? An initial 50,000 ADA position could grow all the way to 70,000 ADA. This really shows the power of leverage for traders who can read the market, creating these amazing opportunities to profit even when prices are falling. But of course, with high potential reward comes high risk. And just as important is whether you can actually trust the platform itself. So let's do a quick reality check on the risks and take a look at Surf's performance so far. First and foremost, let's be crystal clear about this. Leverage trading is risky. If the market moves against your position, you can absolutely lose your money. This isn't some guaranteed path to riches. It takes real skill and very careful risk management.
So what about the protocol's security? Well, Surf has taken some pretty big steps to build trust. It's gone through 2 separate audits from security firms, and its smart contracts, that's the actual code that runs the whole thing, are open source, which means anyone can go and inspect them to look for issues.
Now let's look at performance. The protocol has 1.6 million ADA in liquidity. That means there is a deep pool of assets available for borrowing, which is absolutely essential for the platform to run smoothly and without any interruptions. And get this, in its very first month, the platform attracted 15 million ADA in total value locked, or TVL. That's a total amount of assets that users have deposited, and it's a huge sign of strong initial trust and adoption from the community.
And what about profitability? On its peak day, the protocol generated nearly 50,000 ADA in fees.
And those fees, they get distributed to holders of Surf's native token, which shows the platform's huge potential as a revenue-generating engine for its own community.
But the team isn't just kicking back and relaxing. The protocol is always evolving, with a major upgrade right on the horizon. So let's take a quick look at what's coming up next in Surf version 2.
Surf v2 is promising some major upgrades. Dynamic interest rates will mean higher yields for suppliers when borrowing demand is high. Partial loan repayments will offer a lot more flexibility, and support for multi-collateral positions will give users more options for their assets. All of this stuff is designed to make the protocol more efficient and way more user-friendly.
Which brings us right back to the main choice here. On one hand, you have the steady, reliable current of passive yield. On the other, you've got the potentially massive waves of active, leveraged trading. So the final question is for you. Based on your own goals and your stomach for risk, how would you navigate these new tides in Cardano DeFi? Thanks for tuning in.